So today we're going to be talking about small commercial lending. Is this the silver bullet that everyone on the YouTube channel is hoping for, guys?
Quite possibly. This is a really cool product that not a whole lot of people know about. And this is a solution that we have found real estate investors really thrive with when they look to take the next step and to go into real estate investing full time. Anybody can get this loan. It doesn't really matter if you are a business for self or not. It's essentially somebody who is looking, probably maxed out on their GDS, TDS ratios on the conventional side, who has a decent portfolio, who has some cash, has decent credits, and who is looking to expand the rental portfolio.
What is up, YouTube? Matt McKeever here. We've got Josh and Ehren from the Findlay Mortgage Team back. Hey guys, how's it going?
Hey, thanks for having us. Doing well.
So today we're going to be talking about small commercial lending. Is this the silver bullet that everyone on the YouTube channel is hoping for, guys?
Quite possibly. This is a really cool product that not a whole lot of people know about. And this is a solution that we have found real estate investors really thrive with when they look to take the next step and to go into real estate investing full time.
Yeah, we've talked about some of the small commercial before, and we brought it up and mentioned how when you start using this product, we start debt servicing based off of the subject assets performance and how its revenue relates to the expenses on there, and we're looking for some specific debt servicing ratios on the property itself. So again, just getting away from that personal debt servicing and relying more on the asset opens up a lot of flexibility for some of the borrowers.
Yeah, I think it's important to start with maybe like an example of why somebody would use this product. So let's just say we have an investor, and that investor is business for self, does really well, but has tax advantage accountants who say, you should probably not claim, all of your income on your taxes. Maybe pay yourself some dividends consistently, and then keep cash in your corp and do whatever you'd like with it. So we see that a lot, just obviously maximizing your situation, but everybody knows that lenders don't necessarily like that because they can't prove the income. So we have people who are looking to BRRRR, but with no solution. Well, this is the solution. As Ehren said, you can base the loan off of the actual debt servicing of the property itself. Now, this isn't to say that you can just be a degenerate and have a 500 credit score and no cash in the bank and get a loan. It's not how it works. But the majority of the qualification is based off of the actual cash flow and NOI of the asset. For anybody who's looking to purchase a property in a small commercial space, that's a single family home, duplex, triplex, or fourplex. Fiveplex and up is full commercial. So if you're looking to purchase a regular residential unit, but with this product, you can do that. Also important to note that each individual bank has their own specific underwriting parameters. So what we're about to talk about today is going to be a average or generalization of all the different products that we have access to.
Yeah, so I guess kind of just jumping into how we really take a look at it. We take a look at the building's debt service coverage ratio, DSCR ratio. Like Josh said, every lender kind of has their own unique parameters, but in general, we want to see that property debt servicing about 1.2 to 1.35, depending on the type of property that we're going to be looking at, whether it's a potentially owner-occupied property and they're using the cash flow from the portfolio of their additional rental properties to cover, or their own personal and liquid net worth, or their own personal income to cover the expenses. Because remember, on this small commercial, small business type loan, because it is a business, they want to see some sort of operating income or income being generated to cover the debt. So on an owner-occupied purchase, they would rely more on their own income coming in. On a rental property, they're going to take a look at the rental income coming in. And then on the student rental properties, which, yes, they do cover student rentals on the conventional side. We need to have full leases in place to be able to move forward with the purchase, but they will use those rental incomes to debt service. On those student rental properties, they do want to see that rental or that DSCR a little bit higher, and that's when you start getting into that 1.3 to the maybe 1.35, depending on the property.
Yeah, the second piece we look at is expenses. So anybody who's purchased commercial real estate, you understand that we usually look at historical expenses provided by the seller to get financing. Or if you're refinancing, we look at your historical expenses that your accountants put together. And we can kind of figure out what your total expenses are and then what your net operating income is and figure out a calculation that way. Residential real estate isn't quite like that. When you're purchasing a duplex from somebody, they don't have their accountant prepared financial statements that outline all the utilities for the last few years. So most of the banks use something called a benchmark expense ratio. And this ratio outlines essentially a percentage of the gross annual revenue that you're going to get on the property as an expense. So it usually tiers based off of who pays the utilities. So if it's a single family home to a fourplex, hypothetically, you can say it'd be 25% of the gross annual revenue as expenses. If the landlord pays the utilities, it's going to be 30%. If it's a student rental and the tenants pay the utilities, it's 35%, and so on and so forth. All the way until you get to like where the landlord pays the utilities for a student rental and it ends up being like 40% of gross revenue. But if you have 6+ bedrooms in a house, you're probably making enough revenue to have that cash flow. The most important aspect of this specific product is you have to have the leases in place. You know, the revenue needs to be there. You need to be able to prove the revenue is there to be able to get this product, because the bank is going to be heavily relying on the revenue on that property to give you the loan. When it comes to the debt service coverage ratio, and Ehren touched on it, it does tier depending on units. So 1 to 4 unit might be a little bit lower of a DSCR, whereas a 4 unit and up might be higher, and then student rentals, they calculate it based off of bedrooms. So either below 6 bedrooms or above 6 bedrooms, and the ratios kind of fluctuate depending on what that looks like.
Yeah, so the next thing they're going to take a look at is just, they do still consider the borrower themselves and what their qualifications are. So there's a few things we're going to need from the applicant. We're going to need a personal net worth statement. We're going to need some sort of statement of rentals, just a summary of, what the income is coming in, what the expenses are, and what that net operating income is. If you have additional properties on your net worth statement, they're going to ask for that income expense report. So just have that ready to go. What's your history of being an investor? Are you experienced? Are you, is this your first time being a landlord, or you have the experience being a property manager? If you're not being the property manager, are we using some sort of additional expense for having a property management company, being hired, and that would be included in those DSCR calculators. So they're going to take a look at you as a whole next. And even if the property initially doesn't necessarily meet that initial DSCR, let's say maybe you're at 1 or 1.1 and we want to be at that, maybe 1.15, they can use, in some situations, the additional income coming in, either from your passive rental income or from like a job salary income coming in, to help bump that up there, depending on what that net worth statement looks like and what additional expenses they may have. So that's why it's good to have a strong borrower profile, because it can help make the lenders feel more comfortable moving forward with that mortgage.
Yeah, the next, the golden question is setting expectations. So, okay, well, what's my rate going to look like? It's decent rate. Usually it's between mid 2s, say 2.75 to 2.99 is what we're qualifying with on these types of products. You're probably around between 75 and 80% loan to value, depending on the bank that you're going to be using. You have a 25-year AM. They do offer variable and fixed terms, depending on obviously what your strategy is. If you are looking to have access to it and reduce your overall expense to break, taking that variable option is still available to you. This option is ideal for somebody who doesn't want to use a B lender. You're not stuck with having to do large offsets on all your properties to figure it out. You're just able to get the product. Now, that being said, you are with usually a credit union, and they do have caps on how many of these you can do with them at a specific bank. Just keep that in mind. But the product's great, great rate, great terms, gives you the flexibility you'd like. It just really depends on the actual asset itself. This product doesn't necessarily always work on acquisition, especially if you're purchasing under rented property. This is takeout financing. Unless you're buying a turnkey property, which is kudos on you, we can probably get it done, but the majority of our clients are using this to take out some either probably more expensive financing that they use to acquire the property.
Yeah, they're very strict about having those leases in place on acquisition, again, because it's looking at it from a business standpoint. I have had some experience where they've given them maybe a 30-day grace period. we'll have a letter of intent from a tenant saying, I'm going to be moving in at the end of this month. That gives the buyers a little bit of time just to get in. They just revamp the property a little bit, clean it up, get it ready for them to move in. But then, as per the commitment, they have to be in there on the 30th. And these small business loans are very strict on following these guidelines. They want there to be a maintained DSCR throughout the lifetime of the mortgage. So every year they're going to do an account review, making sure that the income coming in is kept at that 1.25% DSCR. If it isn't, they're going to sit down and say, okay, where are we going wrong? Like, what's happened? Has there just been some tenant turnover? Have you had a hard time actually getting, the tenants to stay in there? Like, what's going on? And if you aren't able to maintain that, then, they may not renew, or they might call the mortgage on you, and you have to find a different situation to move forward. But very, very reliant on that. So these long-term renovation projects that's going to take 6 months, this isn't the option for that. If you need 30 days to spruce the property up and you can have a lease in by the end of the 30 days, this would probably work for you. But these long-term burrs, you're looking at either some sort of B or private financing to get in and give you that time, and then come back to the small business and, like Josh said, take that takeout financing from them.
Yeah, and last thing to keep in mind is the most important thing is speak to somebody like a broker before you go and start your BRRRR project, because if you don't understand how much revenue your property needs to produce to be able to support the debt based off your ARV value, then you're kind of dead in the water. You want to be able to rework the numbers backwards, figure out how much revenue you need per unit, and then obviously calculate how much renovations you're going to need to do to that property to be able to get the revenue you need to support the debt. So there is a little bit of number crunching backwards to make sure it works, but speak to a broker before you start the project.
Last thing, just to jump in there quick as well too, one more thing I want to touch on, because it is kind of important, is the process is a little different than when you go to a conventional lender. If we go to an A bank or a B bank, we submit it in for approval within 3 to 5 days, we get a commitment. It's a lot different on the small business side, where they need to have that appraisal first. So you're looking at a timeline from when you get that property under contract to actually getting the commitment can be about 4 weeks sometimes. So a couple things to keep in mind here is just the timeline and understanding how the process works. You're probably going to need 4 weeks for sure to be able to close one of these small commercial type products, just due to the timeline. 6 weeks may be a little bit more ideal. Right now, appraisals are quite busy. Some of these lenders require an AACI. It is a little bit trickier to get them out there. They are much busier right now, so it's not as easy as asking for a rush appraisal, getting someone out there, and then with 3 to 5 days, it's turned around. We're looking at 2 to 3 weeks sometimes for these appraisals. So just understand the timelines and understand you aren't going to get that commitment until after the appraisal. So you're looking at a 3 to 4 week timeline. So just understand that before coming to us. And these quick closes aren't really going to work well if you're looking at a 2 to 3 week closing and trying to get it done small business. It's a lot more paperwork, especially if you're buying it in a holding corp. You're going to have account setup documents. You're going to have business documents to sign, business verification. It is a bit of a lengthier process. So just keep that in mind with the timelines moving forward. And if you are looking to do a quick little BRRRR, and you don't have that lease set up right away, they may ask for a small reserve to cover the rental income to have that. So there may be a small additional cash requirement needed to move forward, depending on what the situation is. So just a couple little caveats there to keep in mind before looking to move forward on these.
Awesome. And then before we wrap up, I think one last thing I just want to touch upon is, who is the ideal avatar for the person getting these mortgages? Again, just for anyone sitting at home that was like, okay, we started talking about small businesses. Do I need a small business? What's going on exactly?
Gotcha. So small business is essentially just a classification based off of the type of loan they're going to be giving you.
Yeah, the rental property is the small business in this case.
Anybody can get this loan. It doesn't really matter if you are a business for self or not. It's essentially somebody who is looking, probably maxed out on their GDS, TDS ratios on the conventional side, who has a decent portfolio, who has some cash, has decent credits, and who is looking to expand the rental portfolio. This is a phenomenal tool that's going to keep your costs down, your rates at a decent price, decent leverage on the property, and it's going to give you solutions to be able to grow and help you move forward. So if you are getting capped by the banks based off of your personal income, this is definitely the solution.
Awesome. Perfect. Really appreciate it, guys. And if you guys want to learn more about this, we'll have a link to their contact information in the video description down below. So make sure you jump over and just grab it. Otherwise, the Findlay guys actually have their own YouTube channel as well. So you guys are doing a video still once a week.
We are, yeah, we're trying to drop as much content as possible. We're actually pushing out a bunch of content this year. So if you don't follow us already, go and follow us. Hit the subscribe button down below. We would really appreciate it.
Awesome. Thanks, guys.